Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. There's plenty of evidence to suggest that with all the international and most domestic travel now off the agenda, people are looking for new ways to spend their money. It's resulted in a good boost for retailers like JB Hi-Fi, Harvey Norman, and online sellers Temple & Webster and Kogan.com. But what does it mean for investors eyeing off discretionary retailers on the ASX? Roger Montgomery is the founder and chief investment officer of Montgomery Investment Manager. Roger, welcome to Fear and Greed this morning.
Always good to be with you.
So tell me, exactly what is a discretionary retailer? Who are we talking about?
So we're talking about retailers who sell things that aren't essential, that aren't necessary. Really anything other than food is a discretionary retailer. So you've got Woolies and Coles, and then everything else really does get captured by that discretionary descriptor.
So take me through some of the better performers of the last year, or just the sector generally. It seems to have had a pretty good run this year at least.
Yeah, so interestingly, last year, 2020, when the lockdowns first hit, obviously everything in the stock market was hit pretty hard. But then what we discovered is, as a consequence of people being locked down at home and having or continuing to be paid either by their employer or by the government, and without their boss looking over their shoulder, they were doing a lot of online shopping. And so what happened is a lot of the discretionary retailers reported very, very strong growth from their online offerings, and online retailers reported extraordinary growth, and we're talking triple-digit growth year on year. So it was a big deal. But what we also saw was a shift, or what we call in our industry a mix shift. And so what happened is the mix of spending changed. So basically experiences which are supplied by service providers, so the likes of movies, concerts, restaurants, those sorts of things, they died completely. Nobody was allowed to do any of those things, so that stopped. And with the extra dollars that would normally be spent on those things, and also the extra 43 billion Australian dollars that would normally be spent when Australians travel overseas, that was all redirected to goods in Australia supplied by, in many cases, Australian retailers. And so discretionary retailers did well, services not so much. The same thing is happening again now, except there's a bit of a twist in that with the lockdowns we're in now, people have spent a lot of their money. Let me rephrase that. They haven't spent a lot of their money. They've still got a lot of money. They've spent on what they wanted to spend last year, and so they're not spending again. Hopefully that gives you a good description of what's transpired.
Yeah, absolutely. It is interesting in that I think you've called it economics of enough.
Yes.
The idea that people, they purchase, you can buy a new TV because you're in lockdown, but that's not a purchase you make every 6 months or every 12 months. It's probably every 3 or 4 years.
Yeah, so these products have a life cycle, and they're replaced either because they fail or technology becomes superior, and so that replaces or supersedes the technology you've already got. So what happens, you get a big surge of spending and then people just have enough stuff. And it's really, really quite simple. And I've been talking about that since the 1980s, that people just have bought enough for the time being. And they'll buy more again, but it slows down. And so it means for retailers that because people have got enough TVs, they've bought enough printers for the home office, they've bought enough gym equipment for their home gym, they're not buying more of it. And what it means for retailers is that they have to be more competitive, they tend to have more promotions, and so their margins start to get compressed. And in fact, this reporting season, that's exactly what we've seen. We've seen retailers report really, really great results for financial year 21, which ended on June 30. But now what they're saying is that, partly because of lockdown, of course, but in the first month or two of the new financial year, sales have dropped off. So in some cases, for example, Accent Holdings, Adairs, Supercheap, JB Hi-Fi, they're all reporting a lot more promotional activity, so discounting, which is crimping their margins. And they're also reporting very, very sharp 14, 15, up to 20% declines in sales compared to last year. And that really does reflect not only the lockdowns, but also what I describe as the economics of enough. People have just bought enough stuff for the time being.
So it doesn't augur particularly well, and we will come out of lockdowns eventually. So let's say October, November. I'm just thinking ahead here with discretionary retail. If the economics of enough has kicked in, and I know when I'm out there, I'm not going to buy a new TV. I'm going to go out for dinner.
Exactly.
I'm going to do all that stuff that I haven't been able to do.
Yes.
It doesn't sound great for those retailers.
That's exactly right. And some of them are on fairly lofty price earnings multiples as well. So, companies like Domino's Pizza, for example, will continue to do well in lockdown. They may continue to do well after lockdown. It's kind of a discretionary purchase, but not really. People still have to eat. But then, the Kogans of the world, the JB Hi-Fis, Breville Groups, Harvey Norman, even Bapcor, which is a a parts supplier, car parts supplier.
ARB, some of those sorts of people.
Yeah, Super Retail. ARB is just an exceptionally good business.
Right.
Just as an aside, one of the top 10 companies listed on the Australian Stock Exchange.
Really?
Oh.
So for those who don't know ARB, they basically provide four-wheel drive accessories primarily.
Aftermarket four-wheel drive parts and accessories, that's right.
Yeah.
But those businesses that I've listed, and then, you could add to that Baby Bunting and Adairs and Lovisa, Nick Scali, those sorts of businesses, and I'm, racking my brain to think of a few more. But they're the sorts of businesses that are all generally reporting tougher comps, what we call tougher comps. So their comparisons, they had really good numbers last year. The growth rate might have been 50%, but this year it's really hard to repeat that 50%. So they're going to show lower rates of growth. And these lockdowns are really having a detrimental impact on the operating profits of many of these businesses to the tune of 20 to 30% in some cases. So it really is having a big impact on this first 2 months of the year, of the financial year, compared to the first 2 months of last financial year.
Stay with me, Roger. We'll be back in a minute. My guest this morning is Roger Montgomery, founder and chief investment officer of Montgomery Investment Management. One thing about retail, and I remember as a reporter, when you first reported companies, often you did retail because everyone can identify with it.
Yes.
From an investor viewpoint, what are the things I should be looking at if I want to buy retailing? And with it in the back of my mind, I'm thinking, well, actually, if I'm not going to buy a new TV, why should I invest in Harvey Norman or JB Hi-Fi or whatever?
Yeah, look, let me start with the easiest way to make money in the Australian stock market, and that is...
we've been waiting, Roger, for years for this. Off we go.
It's really simple. If you get a really good retail concept that only has a small store footprint, and it's rolling that store footprint out, one of the surest ways of consistently making money in the stock market is to buy that retailer when it's at 20 stores and it's going to 150 or 200 stores. You will do very, very well over years owning that business.
Domino's being an example.
Yeah, well, all of them, Nick Scali is another classic example.
Yep.
When they roll out those stores and they go from, as I say, 10 or 20 stores to hundreds, you're going to do very, very well. And that's because often the really good retail concepts, they start to pay back on the CapEx, capital expenditure for the store layout. They start paying that back very quickly. And so what happens is not only do you get growth in earnings, but you also get analysts upgrading their earnings because a good store concept will do better than conservative analysts are willing to estimate. And then they tend to upgrade. And then that upgrade flows through to a PE expansion where people start projecting it out to infinity. So you get growth on growth on growth. And that's really good for share prices, and you make a lot of money doing that.
Any in mind at the moment, Roger, just between you and I?
No. Look, well, actually, you know what? Our biggest position in the small caps fund amongst the discretionary retailers, and we've got 5 or 6 discretionary retailers, our biggest position at about 3% is City Chic, which is a plus-size women's retailer, and it's made some acquisitions of what a lot of market analysts think are some underperforming businesses in the US and the UK. But if they can transform those businesses and do what they've done with City Chic in Australia, they will really roll those store concepts out very successfully and make a lot of money out of that. We've also got, and I'll list these in order of size, but the biggest is 2%, the smallest is 1%. Lovisa is another one where Lovisa sells what I describe as costume jewellery, but affordable jewellery. Warren Buffett owns a lot of jewellery stores. You can make a lot of money out of jewellery stores. GWA, which is not discretionary retail, but sells things like basins and sinks and toilets. Bapcor, which I mentioned earlier, Adairs and Super Retail Group. So in order of biggest to smallest, that's what we've got.
Wow. Just moving away from discretionary retailers, what about the consumer staples they're called? You mentioned Woolworths and Coles being the obvious ones. How do they look as we come out of lockdown?
Woolworths is a particularly interesting example because it's a mature business, it's in a mature market. Nobody thinks of it as a growth company, but What happened is in the first couple of months of the first lockdown last year, 2020, what happened was they signed up 1 million new online and rewards customers. And because their ability to convert those customers and upsell them and cross-sell to them is probably 2 years ahead of Coles, it suddenly became a growth story again. And so Woolies is a particularly interesting example where they could be growing at rates faster than GDP for another couple of years.
That's really interesting. I mean, what came to mind then, and I shouldn't say that, but Stephen Kane, the head of Coles, is always pictured in his Coles T-shirt.
Yes.
And I often think it actually isn't a good look for the CEO of Coles when I want to invest the money to look like a grocer, whereas you don't ever find the CEO and senior management of Woolworths doing that. Purely an image thing, that, but their investment in Quantium too, the data play, obviously that feeds into what you're talking about.
Absolutely. And as I said, Woolies invested heavily and early, and that's now paying dividends for shareholders. Look, really, as a professional investor, and we own Woolies and we own Coles in our large cap or all cap funds, but really it comes down to price.
Yep.
We know that Woolies is growing a little bit faster than Coles, but there'll be a point where Coles gets marked down in price and rejected because Woolies has been growing so successfully that Coles becomes the better investment.
Yeah, right.
Simply because it's cheaper.
Yep.
And so you over time you tend to rotate between the two.
Just before you go, I have to ask you, why do you like ARB so much? I'm really interested in that company and have followed it for a while, but I'm just interested in your view on it.
So the definition of an extraordinary business is very specific, and I hope you don't mind me mentioning, I have a chapter on this in a book I wrote about a decade ago called Valuable. But the definition of a high quality or extraordinary business is basically a business that's able to take large amounts of its profit every year and reinvest it at a high rate of return.
Yeah.
So you want a business that can grow its equity and then generate a very high rate of return on that growing equity. It's a little bit like having a bank account with $1 million in it earning 5%. But I tell you that when it gets to 10 million, I'll start giving you a 10% return. When it gets to 20 million, I'll give you a 20% return.
Yeah.
When it gets to 50 million, I'll give you a 50% return.
Yep.
And that is first prize in capitalism. That's the business that you want to own and you never want to sell a share of it. ARB has been able to do that. As its equity has grown, it's been able to maintain a very high rate of return on equity on that growing equity. And it does that because it's got sustainable competitive advantages. Even in Thailand, where its products are copied and people put ARB stickers on their fake ARB bull bars, people still want the original ARB product because they know it's safer, it's high quality, it's going to last and it's going to work. And that's why. And I have a four-wheel drive and I'm taking it to ARB in a month to have them fit a dual battery system in so that when I'm allowed to go camping again, I'll be able to run a fridge and the kids can charge their phones and all that sort of thing. And when ARB gave me the list of everything they were going to install, I went online and I found every one of those products at a cheaper price than what ARB were going to charge me.
Yep.
But I didn't care because I know ARB will put a warranty on the installation of all those things and they'll look after it and they've got really great after sales service, and that's what I'm paying extra for. And that's why they are able to charge more for the same product and people will still cross the road to buy it because they've got such a great reputation. That you can't replicate, that you can't copy, that is very hard to compete with, and it means their return on equity or their high rate of return on equity is sustainable.
Fantastic. Roger, thank you for talking to Fear and Greed this morning.
Always a pleasure.
That was Roger Montgomery, the founder and chief investment officer of Montgomery Investment Management. This is a Fear and Greed daily interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.